This is trading lesson 10 for Forex traders, cryptocurrency traders, option traders, and stock traders. Delivered by Tuigbe Izoge. Classes begin as thus. A higher low after a possible trend reversal into a bull is a good buy setup. A fade of a second higher high or lower low setup is even more likely to be successful because they are second attempts to reverse the market, and second signals are good setup on trading range days. On trend days, horizontal lines should generally be used only to enter on pullbacks. For example, if there is a strong upside breakout of a trading range on a bull trend day, there might be a pullback to the area of breakout level after a few bars. If there is a bull reversal setup on the test, this is a good breakout pullback buy setup. Second signals are the best. A second higher high or lower low is a more extreme point on a trading range day where the middle of the day acts like a magnet, and this further extreme is therefore more likely to yield a scalper's profit. Don't fade strong trends. The best risk-reward ratio occurs when you enter on the first pullback after a trend line break, before there is a clearly established trend. Why is it important to recognize the existence of a trend? Because then most of your trades should be in that direction, and you must try to take every with trend entry and really take counter trend entries. Depending on how you define a trend and a reversal attempt, about 80% of attempts to reverse a trend will fail. Markets have inertia and tend to continue what they have just been doing. Because of this inertia, it makes far more mathematical sense to wait for the reversal attempt to fail and become simply a pullback in the trend and then enter in the direction of the trend. Incidentally, market inertia also means that if a market is in a trendy range, it will resist breaking into a trend, and about 80% of breakout attempts will fail. When the market is in a bull trend, look for buy setup in the final hour. Likewise, when the daily chart is in a bear trend, look for sell setup in the final hour. As the 5-minute chart will often sell off into the close, causing the bar on the daily chart to be a bear trend bar. Big traders don't hesitate to enter a trend during its spike phase because they expect significant follow-through, even if there is a pullback immediately after their entry. If a pullback occurs, they increase the size of their position. For example, if there is a strong bull breakout lasting several bars, more and more institutions become convinced that the market has become always in long with each new higher tick. And as they become convinced that the market will go higher, they start buying. This makes the spike grow very quickly. They have many ways to enter, like buying at the market, buying at a 1 or 2 tick pullback, buying above the prior bar on the stop, or buying on the breakout above a prior swing high. It does not matter how they get in because their focus is to get at least a small position on, then look to buy more as the market moves higher, or if it pulls back, because they will add on as the market goes higher. The spike can extend for many bars. A beginning trader sees the growing spike and wonders how anyone could be buying at the top of such a huge move. What they don't understand is that the institutions are so confident that the market will soon be higher, that they will buy all the way up because they don't want to miss the move while waiting for a pullback to form. The beginner is also afraid that his stop would have to be below the bottom of the spike, or at least below its midpoint, which is far away. The institutions know this and simply adjust their position size down to a level where their dollars at risk are the same as for any other trade. The most recent bars are at the top of your computer screen in a bull trend and at the bottom in a bear trend. And psychologically, there does not appear to be any more room for the market to go further. The result is that many traders won't take a great buy signal at the top of a bull trend or sell signal at the bottom of a bear trend, and we instead look for reversals. But that computer screen illusion has nothing to do with the market. And if you can add space above or below the chart, there suddenly will be lots of room for the trend to run. The market draws in counter trend traders, and if you enter in the direction of the trend exactly where the exit at a loss, they will drive the market in your direction, even though the market looks so overextended.